Hi, and welcome back to yet another episode of The Mortgage Musketeer, where today we're going to be talking about escrows. Yes, in this episode we're going to be talking about your property taxes and your homeowners insurance escrows. What does it mean? How are they calculated? Stay tuned. Alright, escrows. Escrows are nothing more than the lender or the loan servicer putting aside a portion of your taxes and your insurance so that when your property taxes and your homeowner insurance are due, they have money to pay it for you. So that is included in your monthly payment. So to make numbers easy, let's say that you have a homeowner insurance policy for $1,200 a year. So that's $100 every single month. Well, that $100 is part of your monthly mortgage payment. So you have your principal and interest, your homeowner's insurance, your property taxes, and you may or may not have some mortgage insurance. And that's all part of your monthly payment. When you make your monthly payment, the lender or the loan servicer is going to take that $100 for your homeowner's insurance and put it into an escrow account. And they're going to do that every single month. Okay, and at the end of the year, when your homeowner's insurance is due again, they are going to pay it for you. All right, so same concept with your property taxes. They're going to take out whatever your yearly property tax amount is, divided by 12. That'll be in your monthly payment. They're going to take that out of your monthly payment every month and put it in an escrow account. And then when taxes are due, they're going to pay your taxes for you. All right, when you go to close on your home, you have to pay 1 full year of homeowner's insurance up front because you pay it. It's hazard insurance and homeowner insurance, same thing. You're going to pay that up front so you're covered for the year. The next 12 months, they're going to be taking that out of your payment. So it depends on where in the year you close. So let's say that you closed in the month of June. So we close in the month of June, your first payment is not due until August 1st. So you pay in June or you close in June, there's no payment. No payment in July, and then August 1st is your first payment. But you closed in June. That means that next June your homeowner's insurance is due again. But if your first payment was in August, that means that you've only made 10 payments when next June comes around. So your escrows would be short. So when you close on your home, they're going to establish your escrows. And typically what that is they're going to take the 2 months, the month that you closed, June, the next month that you didn't have a payment in July, and then they're going to put on an extra payment as a buffer. So on an average, it's about 3 months. So that next year, when June rolls around again, you have enough money in your escrow account to pay next year's homeowner insurance. Now your property taxes are very similar to that, but it's a little bit more of a calculation because your homeowner insurance is due the month that you closed. Your property taxes are due depending on where you live. It's different for every county and every state. Usually it's November, but some pay twice a year, some pay, I've seen it 3 and 4 times a year, and it's not always equal. It's funky. Whatever that is, they're going to establish your escrows for your property taxes as well. So let's just make this example simple and say that your taxes are due at the end of the year. So it's the same exact concept where they have to establish your escrows for your property taxes as well. When they do the calculation, you're going to see basically the year's worth of property taxes, but just understand that the seller is going to pay property taxes up to the point at which you buy the home. So they're, in that example that we use in June, they're responsible for paying property taxes up through that point. And then you're going to establish your property tax escrow. How that works out is slightly dependent upon the lender, but on average it's between 3 and 5 months. Usually around 4 and some change. And the reason they do that is because, same example as the property taxes, but they want to make sure that you're covered because if you don't pay your property taxes, they can put a lien on your house. So they're always going to lean a little bit extra on that side so that there's no doubt you're not going to come up short on your escrows. So again, depends on where you are in the year as to how much they're going to collect. But then there's also something called an aggregate adjustment. We won't get into that in this, but basically what it means is that you can only have so much in your escrow account by law, and if it exceeds a certain amount, they're going to do an aggregate adjustment and take it out. You'll see that on the loan estimate, your in the closing disclosure, your loan officer can explain that in more detail, or I'll do another video that breaks down the aggregate adjustment. But just understand that for escrows, that's really all you're doing, is you're putting money aside in an account, if you will, in an escrow account, so that you have enough money to pay your property taxes and your homeowner's insurance. All right, hopefully that was helpful. You go ahead and hit that bell for me, and hit the like button, and subscribe, and tell everybody you know about these videos, because the idea is to educate you so that we can get everybody feeling comfortable about the loan process. Take the mystery away from it, because it's all for one and one for all.